Since it doesn't seem to matter to us, most people are either unaware of it or haven't given it much thought. We are approaching a cathartic moment because this is becoming so severe, and I do believe it began. This cathartic moment is good, in my opinion, because there is so much misunderstanding. These corrections are difficult in the near term. Many have believed that the world will operate in a certain way, and now it isn't. There are numerous ways and evidence that fear is permeating the marketplace. First, let's just examine the numbers. After reaching a peak of 27% in 2020, M2 growth has been decreasing ever since. On an annual basis, we think it is approaching or maybe below 3%, which leaves little space for inflation or growth, until velocity, the rate at which money is turned over, really picks up. Additionally, we don't think velocity is increasing in this context. If anything, I believe that people and companies are growing increasingly worried and are spending less freely. During this bull run, we've reached a critical juncture when liquidity is beginning to dry up globally, particularly in investment markets. The majority of businesses are actually currently reducing their workforces and have no intentions to grow, if you look closely at what they are doing. And in general, that's a pretty fair indicator of the direction the economy is taking. This is simply what they usually do if they are certain that things are probably going to slow down and that there is little clarity about when more money will be printed and when the business cycle will have more accessible liquidity. We don't really know what that will look like until the Fed actually announces exactly what they intend to do in terms of quantitative easing, or until other nations begin selling their bonds and converting the US dollar to their own currency, which would increase US dollar liquidity for the rest of the world. We did, however, receive some fantastic updates regarding China and Japan. At the moment, several of them are selling off a large number of US bonds, which naturally increases market liquidity in the US, exactly what US consumers require. You can see that the US market is truly making a lot of money when you compare China with the US market. Russia and Japan are essentially doing the same thing at the moment. Considering how dominating the US dollar has been, particularly in recent years with all of the continuous trade battles we've been witnessing because of Donald Trump's policies, even Europe is taking some steps to strengthen their currencies. So, keeping that in mind, since economics will begin to play a bigger part in the cryptocurrency world, I do want to elaborate a little bit on what Cathie Wood is saying here. I find a lot of this to be really fascinating, so pay attention, and let's return to Cathie Wood. I do believe that the guilt trip was the catalyst for this, and it is becoming so serious that we are approaching a cathartic moment. Additionally, the Fed has admitted that its actions have global implications, although it is primarily considering the United States. This brings up a lot of memories of the early 1980s and its events. Treasury ministers from all around the world decided to sell dollars as part of two accords, the Louvre Accord and the Plaza Accord, in order to lessen the deflationary effect on the rest of the world. When I say deflationary influence, I mean that their countries' currencies are depreciating, which makes their inflation rate appear to be either in hyperinflation or on the verge of it. However, dollar-denominated debt that they are unable to pay back is choking them. Longer term, this turns out to be a highly deflationary environment. We want to know what the weak point is in the United States. Is it our pensions? We're not sure. We are aware that the US has LDI strategies. We don't realize how leveraged they are, however, one can never be sure. What are some of the weak points that we are observing, if not that? We've been concerned about auto credit for some time, and now we have even more grounds to be concerned. We received the Mannheim Used Car Index yesterday. Effectively priced as a value index, it fell by an additional 3% or more. Last month, it decreased by more than 4%. As a result, the annual rise has decreased from 54% to minus 0.1. There you have it, Fed. Another sign that the system is experiencing deflation is this. That indicator is currently down 14% since January when it peaked. It is decreasing at a pace of over 20%. Why is this significant then? Assumptions on the residual values of cars are made by investors or by a variety of auto publications. Additionally, those residual values have been steadily increasing, albeit perhaps not as much as the used car index. The used car price index will plummet here if we are correct. Why? During COVID, a lot of people purchased cars in order to avoid using public transportation. They wouldn't have needed the car in normal circumstances. However, they were pleased to see that the prices of used cars were rising, and they planned to sell back into the market once everything was under control. At one point, used automobile prices were up 54% year over year, as I previously noted. They're flat to the ground now. Additionally, dealers who overpaid for second-hand cars are now sitting on losses and will need to disgorge their stocks. Because carrying inventory is expensive, particularly in light of rising interest rates, they will therefore have to sell, and we think that's already taking place. Additionally, there is almost $1 trillion in auto paper. Although this won't be a systemic danger, many investors will be surprised because auto paper was the best performing paper from 2008 to 2009. What is the United States' other weak point? Well, companies are heavily indebted, large debt. They've been serving short-term shareholders who want them to pay dividends and don't mind that they're getting more indebted, or who want them to buy back shares and don't mind that they're using leverage to do it. This is becoming a significant issue for some economic sectors that are experiencing both cyclical and secular transformation, and I believe the retail industry is one of them. We continue to be amazed at the accumulation occurring outside, and from a deflationary perspective, which we believe to be the greater risk at this time, the pipeline is brimming with deflationary signs, beginning with commodities, which we will discuss shortly. However, retailers are overflowing with inventory at the consumer level downstream. The most recent example is Nike, which is a retailer but mostly sells to retail. Nike saw a 44% rise in inventory. The consumer was already showing obvious indications of weakness. Its inventory in transit, primarily from Asia, which means it is on ships, increased by 85%, while its inventory in North America increased by 68%. To clean the shelves, you are aware of what will occur. Both Nike and merchants will need to reduce their prices. Furthermore, we think that this is only a small sample of a much larger issue. We anticipate seeing it in full force. To be honest, it's very startling to see so many of these numbers from major retailers, like Nike. Compared to a few years ago, people are purchasing far less. You might even go grocery shopping during specific hours because of our severe supply chain shortage. The difficulty currently is the opposite. Therefore, in order to cope with all of this surplus inventory, many people will be forced to reduce their production and drop their prices. Because they don't want to jeopardize their current profit margins in the United States, Nike is currently working on shipping these enormous cargo containers overseas for sale in other markets. However, if they are unable to sell in these other markets, they will be forced to keep lowering their prices.